In this week's video, we'll cover a wide range of present-day and historical facts that support the following statement. History says stocks could still soar to unimaginable heights. From a human psychology perspective, and the ability to wrap your mind around it perspective, the following statement is almost comical. Demographic Sweet Spot says bull market could last until 2035. The basic takeaway from last week's video was millennial demographics are similar in 2019 to baby boomer demographics between 1984 and 1987. This period here is similar to this period here. We've been doing this a long time, and I'm confident that some of you have had this type of thought. Today is significantly different. Stocks have been rising for 10 years. Stocks cannot keep going up for another 15 years. Thus, it's borderline comical that you're comparing the two periods. All of that seems reasonable and rational. Let's see if that's actually the case. Here's the S&P 500 in the prior demographic sweet spot. And if you know your market history, you know that the sweet spot did not occur at a major low. The major low came at the bottom in the 1973-1974 bear market, a bear market that saw devastating losses. And as it turns out, it took exactly 10 years of a new bull market to reach 1984, one of our guideposts from last week's demographic video. And from this general window here, despite the fact that the market had already rallied for 10 years, the secular bull market was far from over. From the end of 1984, one of the periods that we mentioned in last week's video, to the peak in the stock market in March of 2000, the market rallied for an additional 15 years. Thus, today really isn't significantly different. Stocks rallied for at least 10 years heading into this window here. So rather than today being significantly different, today is actually strikingly similar. The S&P 500 dropped over 50% in the financial crisis bear market and made a low in 2009, and has since rallied for 10 years, taking us to 2019, a period that we said was very, very similar to this window here. Well, after this similar demographic window here, stocks did indeed keep going up for another 15 years, telling us that we can really just draw a big X through this statement here. And from the end of 1984, the S&P 500 tacked on an additional 814%. That does not include this move here off of this low. What was one of the main drivers for this massive move here? Demographics. What could possibly enable the stock market to go up for another 10 to 15 years? We can answer that with two words. The first is supply, and the second is demand. The details of that demographic analysis can be found by Googling demographic sweet spot short takes, and then you can click on this link where my cursor is. Do we have any other form of objective, unbiased data that says 2019 looks similar to the 1984 to 1987 window? It's a weekly chart of the S&P 500 2016 on the left side of your screen, basically the present day on the right side of your screen. It's the 200-week moving average in blue. This white space here tells us that we have a very strong and sustainable trend. The slope of this 200-week moving average tells us that we have a very strong and sustainable trend. The fact that the market came down and tagged an upward sloping 200-week moving average basically confirms that we have a strong and sustainable trend. How many times in the past have we seen a similar setup? A very long-term, strong rally above an upward sloping 200-week moving average. Then the market eventually needs to consolidate its gains. It comes back down near an upward sloping 200-week moving average, makes a stand, and then rallies strongly. And this strong rally off of the 200-week aligns with the concept of a very rare and important breadth thrust that we covered on January 21st of this year. Let's quickly go through the cases. They all look similar to the present day. Strong trend, white space, upward sloping 200-week moving average. The market needs to consolidate its gains. It comes back toward an upward sloping 200-week moving average and makes a stand and rallies sharply. Similar situation. Basically, everything that we said about the present day chart and the prior chart applies to this 1953 to 1958 chart. See how we hug an upward sloping 200-week? This is basically the market's way of saying this is a relevant guidepost. Notice the trend relative to the moving average really doesn't even have a hiccup in here. Similar situation here. We've got white space. We come back to an upward sloping 200-week moving average and the market makes a stand. In the next slide will show us that the answer to this question is yes. We have a very similar situation here. A strong trend with an upward sloping 200-week moving average. A lot of white space between price and the 200-week moving average. The market is getting ahead of itself. It needs to consolidate its gains. It comes back and tags an upward sloping 200-week moving average and rallies. Very, very similar to the tag that we saw in late 2018. Some similar characteristics on this chart. Upward sloping 200-week moving average, white space between price and the MA. We come down to the MA and the market holds with the trend remaining intact. 1995 case, we have a very strong trend. This is a steeper slope and price doesn't come back and kiss it. It actually holds above it and then rallies strongly. Somewhat similar look, 2013 to 2016. A lot of white space, steep slope. Come back and hold above an upward sloping 200-week moving average. We can go back and look at an S&P 500 chart all the way back to 1925. There are only 7 cases that are similar to the present day, and we have covered all of them. Therefore, it might be helpful to know what happened next in the stock market. A devastating and multiple-year bear market? No, the answer is really, really good things happened. If we project forward 5 years from these similar lows, median gain was 93%, and in every case, the S&P 500 was higher. 1 year out, 2 years out, 3 years out, 4 years out, 100% of the cases, the market was higher. And that's not really shocking when you look at the slope of the 200-week moving average. And if you were taking a technical analysis test and were asked, does this look like an unsustainable trend, this 200-week moving average, or a sustainable trend? The answer would be easy. If you're concerned about small sample sizes, you can pause your video player. Let's take a broader view of this type of look and see what we can learn. This week, we meticulously walked through this chart and looked at every case. These are the similar cases that we just covered. There is a logical and rational reason why we eliminated every other case. For example, 1929, we do not make a stand at an upward sloping 200-week moving average. Dot-com bust bear market, we do not make a stand at an upward sloping 200-week moving average. We pierced right through it in the financial crisis bear market, and the 200-week moving average was flattening out and rolling over. 1929, dot-com bust, financial crisis. They really don't look anything like what happened when the market held in 2018. And in each case, really bad things happen. Difficult market followed by an easier market. Difficult period followed by an easier period. Difficult period followed by what could be an easier period. And remember, we don't need guesswork to try to look at this chart and say, was this a good time to be in? Was this a good time to be in? This table takes care of that. This is the actual performance walking forward from these blue arrows. Since we're looking from the low that we've had in the present day case happened less than a year ago, but almost a year ago. It'll be a year ago right around Christmas time this year. So this table says we still could have significant upside. 1 year out, and we're not even 1 year out yet. The median gain was 29%. The median gain 5 years out was 94%. And in every case, the median gain went up from year 1 to year 2, from year 2 to year 3, from year 3 to year 4, and from year 4 to year 5. Doesn't guarantee us anything walking forward in the present day. It simply speaks to the probability of good things happening relative to the probability of bad things happening. And the basic theme walking forward is we're in the relatively early stages of a secular bullish trend. This is not a secular trend. This is where the secular trend starts in 1982, and then for the most part, from 1982 all the way to the peak in 2000, the S&P 500 stays above an upward sloping 200-week moving average. In the present day case, we have the S&P 500 for the most part staying above an upward sloping 200-week moving average. Now, if we're expecting good things to happen for a long period of time, we probably don't want to be going into a massive and painful recession anytime soon. We still haven't seen a shocking recession-like spike in initial jobless claims. The quote from this week, the more stable monthly average of new claims dipped. It dropped by 750 to 215,000. So looking backwards 4 weeks from the present day, we really don't have any data in hand that tells us we should see something surprising and shocking next Friday. And we're talking about government data that is no stranger to the word revision. This is a very, very difficult report to predict, and we'll just see how the numbers come out. We're not assuming anything. Relative to last week, credit spreads, better, worse, or about the same? The answer is better. These aren't just numbers. Credit spreads tell us about the actions of human beings and their expectations relative to future economic outcomes, the probability of a recession, and most importantly, to them, the probability of bond defaults. Concerns, significant concerns, are just not showing up in this data. How about the National Financial Conditions Index? We have new numbers, better, worse, or about the same relative to last week. The answer, upper left-hand corner, better. You may remember that in early October of this year, the stock market was not performing particularly well. And we noted via these tweets, or more importantly, the reaction or lack thereof to these tweets, that sentiment did not seem to be irrationally exuberant at the time and did not really seem to align with fully invested or an all-in type mentality. We also noted on October 4th, citing an October 3rd Reuters story. Here's a quote. "I am more concerned at this point than I have been at any point in the entire year." Once again, that does not sound like somebody that's fully invested or all in, or that has no cash on the sidelines. It doesn't sound like somebody that's abandoned defensive assets. In this quote, in this article here, were basically about the ISM manufacturing data that had spooked the market. There are a lot of things in the markets that appear to be concerning. The ISM data fell into that category. It was logical to think that it was concerning. But this same article also noted ISM contraction does not necessarily signal long-term market losses. How did we make that statement? We looked at the facts to try to understand, A, is this concerning? And B, if it is, how concerning is it? There were 5 similar drops in ISM dating back to 1982, and as outlined in that post, bad things really did not happen typically following a drop like this. Once again, illustrating the importance of making decisions based on data and not a gut reaction or our emotions. And remember, the case that looked most similar to the present day was the 1995 case, where it was logical that manufacturing sentiment, this is a survey, manufacturing sentiment was negatively impacted by a trade war in 1995. The tension between the United States and Japan was eased a little bit in June of 1995, right here, and the Fed was also in the early stages of a new rate-cutting cycle. Now, it's one thing to be talking about sentiment and or turning bullish when the market's a few ticks away from a new all-time high. It's more difficult psychologically to be doing that in early October after a plunge like this. You can Google this title to find an opinion piece from Mark Hulbert dated October 24th. Basic gist of it, reading sentiment in another manner. It does not look like we have irrationally exuberant market participants. Said another way, present-day sentiment does not look like sentiment near a major market peak. It's Friday evening, October 25th. The S&P 500, if you were busy doing other things, was up 36 points this week. This is a headline from Friday, and very, very similar to this August 26th headline. Basically, the market right now is responding to the fact that things are improving between the United States and China rather than getting worse. Markets moved higher after this news. This was the news Friday. When we covered this chart on Friday, October 4th, when we looked in the rearview mirror from a sentiment perspective, the S&P 500 had fallen for 3 straight weeks. And we basically said the high yield market in the present day really doesn't look like this concerning look here where the S&P 500 was peaking in October of 2007. And even though the S&P 500, looking in the rearview mirror on October 4th, had been down for 3 weeks in a row, we basically said this is a bullish divergence here with JNK and a bullish divergence relative to the S&P 500 in HYG. Both had already made a new all-time high, and to date, the S&P 500 still has not made a new all-time high, so this would still be a bullish divergence. And if we fast forward to Friday, October 25th, both of these ETFs printed new all-time highs, which tells us something about the perceptions relative to future economic outcomes, the probability of a recession, and the probability of bond defaults. The chase for yield, despite a plunge in the 10-year yield here, was not a high priority in October of 2007. The look of this chart here really doesn't look anything like the look of this chart here or this chart here. Talk about guideposts a lot. They can be extremely helpful. This is a tweet from August 5th saying this area here is an area that might give us some good information either way. We held in the same general area on October 5th. Despite all of this gut-wrenching volatility in here, to date it is still held. Also noteworthy, the slope of this line here is the same slope here. While the S&P 500 did not print a new all-time closing high, we did close above this downward sloping dotted line here that had previously acted as resistance. How concerned should we be about the underperformance of small caps? Answer, not very. Here's an interesting scenario that we've thought about. It was also covered in a MarketWatch article dated October 25th. If you read through the remarks that Trump made on October 11th, you can find them here. It is not highly illogical to make the case that this is a possibility. How could that possibly work? The United States may basically say, dropping the planned and existing tariffs is contingent on the following. We will drop them immediately if Phase 1 is signed and if Phase 2 and/or Phase 3 proceed as expected. If Phase 1 isn't signed, they're never dropped. If Phase 2 and/or Phase 3 do not proceed as expected, they come back. Under this scenario, when the U.S. presidential campaign really starts to ramp up, this topic, the topic of tariffs, would be off the table. Something that logic tells us would be very, very appealing to a sitting president that's trying to get reelected. Can't emphasize enough, this is not a prediction. It is one of many scenarios. But stocks have been consolidating for a long time. And logic tells us removing all of the tariffs, so all of the new tariffs that have come into play since the trade war started, and canceling any planned tariffs, would align with a long-term secular trend theory. Let's expand on the concepts from this October 15th Short Takes post. Is today really significantly different from 1984 and 1987? It's the 200-day moving average charts from that post. This is the look that we want to avoid. Peaking process in 2000, peaking process 1973-74 bear market. Notice the look of the trend reversal, the look of the trend reversal. As noted in that post, present day really doesn't look like any of those three and devastating cases. And just as devastating bear markets, it's not a question of if, but when. In terms of market history, this also applies. Secular, mind-blowing, and change-your-life trends. Not a question of if, but when. Secular trends in markets are not uncommon. From a psychological perspective, when you're sitting here, this is what's in your rearview mirror, including the horrible 1973-74 bear market. This is a frustrating period to be in this business or to be an investor. So when you're looking forward from these points here, it's almost impossible to comprehend something like this. So we know the present day, which is on the right, this is the 200-day moving average as of October 25th, really doesn't look anything like these cases. In fact, it looks like a bullish trend. The market needs to consolidate its gains and then a bullish breakout. It's pretty easy to say that the present day looks a lot more like 2011, 2012, or 1993 to 1995. And in those cases, rather than getting devastating losses, really good things happened looking out 1 to 5 years. Similar case here, 1985. The present day looks a lot like this 1983 to 1986 chart. And from a fractal perspective, the present day also has some similar qualities to this chart here. Market needs to consolidate its gains. It's just a little more violent in here. Eventually, after sideways movement, we get a bullish breakout. Therefore, we can say the present day also looks like this 1986 to 1990 chart, which is another way to tie the present day back to the 1984 to 1987 period, the you're out of your mind period that we covered in last week's video. And this period here, 1984, 1985, looks similar to the present day. It's also similar to this arrow that we covered 2 weeks ago in the video. It's very, very difficult to achieve anything in life that you cannot visualize with conviction. There's another way to look at this. This is the devastating bear market here. This is basically the financial crisis for the generation back here. It leaves scars walking forward, scars that take years to heal. There's even emotional baggage in here. From this major secular low, the secular bull did not end for 26 years. It's 26 years walking forward from 1974 to the year 2000. It's also 26 years if we walk forward from the major secular low in 2009. It takes us to 2035. So we just arrived at 2035 by basically looking at market cycles. Well, 2035 is the exact same year that we arrived at, based 100% on demographic data and the law of supply and the law of demand. Remember, we said that the sweet spot would end in 2035? And all of this data tells us that walking forward with a 60-40 balanced portfolio could produce very disappointing results from an opportunity cost perspective. And as we noted last week, this long-term analysis really doesn't change anything that we do from a shorter-term perspective. And the main takeaway is as follows. Given what we know today, and that's a key point, history says in a secular trend, we're better off trying to tolerate 100% normal and to be expected volatility and focus on the longer-term potential of growth investments. The next sentence cannot be emphasized enough. If, when the data shifts, we have to be willing to reassess the odds and, if needed, adjust our allocations. We can't predict the future, but we can assess new data with an objective, unbiased, and open mind, which is exactly what we did with that concerning ISM data that came out early in October of this year. Given what we know today, we're very, very comfortable with our current allocation. And we know under our approach, none of this works unless we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue.